Okay, when the window opens up, you'll get on the top of the list typically is the cash. You don't want that. Year is the nearby contract, December. Next month out is March, following by June and September. Just click the top contract here, the one that has a month, again not using cash. Click on December. It'll obviously depend upon what time of the year you're trading and looking at the resource. It'll be a different month obviously, but you just want to choose the top one because that's going to be the nearby contract. Then go to this area here where it says customized chart. Click that tab, and then it'll open up a window that gives you a chart like this. Okay, and what you're going to do is you're going to scroll down to this little area down here where you can set the parameters. You want to set the frequency to weekly nearest. What that's going to do is going to give you a chart based on weekly ranges using the nearby contract always. Okay, we're going to change it to candlesticks. We're going to change it to 1 year, and make sure this is saying total volume. Okay, total volume. And the reason why you won't get the open interest and volume as you see down here otherwise. Click draw. Okay, and you'll get a window pops up with a new chart here. And what this is a weekly chart using weekly range highs and lows derived from the nearest contract month of the US dollar index. Okay, and if you look at the bottom here, this purple line here that's moving along here, snaking up and down, okay, that delineates the total open interest for the dollar index. And obviously it goes without saying these vertical red and green lines are volume. Okay, we're not going to really pay attention to the volume, but there's just no way for me to take the volume off and just leave the open interest, so we have to kind of look past these vertical lines and pay attention to the purple line in here. Okay, so let's go and scroll down just a little bit. Notice how we rode up in price here on the dollar, and then we went into a consolidation after a small retracement. Okay, see this consolidation in here? We have a range high here, and we have a range low in here. Note the time of the year. Okay, March, April, May. March, April, May. Okay, so that's springtime of this year. Note the low here and the high here and this low. This is optimal trade entry. Pull that up on your platform, pull a fib across that, and you'll see that we did trade right back down to this level here. Now, utilizing this this concept of weekly ranges and seasonal tendencies, okay, typically in the springtime we see a weakness come into the marketplace in the form of the British pound usually making a seasonal high, April, May, and trading down into the summer months. Well, that's going to be a mirror image or reverse, okay, in the dollar. The dollar should rally up at that same time frame, and you see that unfolding here. Okay, now we're going to introduce the concept of open interest, okay, and I want you to take a look at this drop, okay, rather sharp drop in open interest right here during a time frame when we're in a consolidation. This is the commercials tipping their hand that this is now no longer going to be staying within this small little time frame of trading range. Okay, they expect higher prices. Why? Because open interest is declining. We've learned that open interest decline in a consolidation is commercials doing what? Lessening their shorts. If they're lessening their short positions, they expect what? Higher prices. And you can see that unfolding here. Okay, now by itself, that's wonderful. But how do you confirm that? How do you see the X-ray view, so to speak, of this open interest indicator giving you the insight that we're supposing it's doing here? Well, you scroll down to this little area on your page and it says Add Study. Click on this tab here, and you're going to go to Commitment of Traders Line Chart. Tap that, then Draw Chart. Okay, now watch. See the open interest declining here? That's lessening of shorts. The red line down here is the commercials. Okay, they are below the zero line here, so because they are net short. But look what they're doing at the same time here. Middle of March going into April, they're really reducing their shorts. See how they're covering their shorts? At the same time frame, open interest is declining while price is in a consolidation, while price is trading at a key support level, 79. See that level over here? 79. So we can expect reasonably, seasonally, we're looking for higher prices in the dollar, weaker in the fiber and cable. Okay, so there should be a risk off scenario. Risk off is going to draw participants into buying safe haven assets. Now, one can argue that the dollar may or may not be a safe asset to most, but for instance, you can see that still unfolding here with a higher dollar rallying up from the April-May timeframe into the summer months. So then we have this mindset that we're looking for bullish prices in here. Okay, we would be in a buy program all through here. Okay, so now let's look and see if we have that same thing occurring in the British pound at the same time frame in this year, in the spring. So let's go back over to the commodity tab, and we're going to go into the British pound. I'm going to use the nearby contract, and to click on your customize chart tab, and we're going to do the same thing we did with the dollar. We're going to make sure we are on candlesticks. We're going to look at weekly nearest. We're going to scroll to a 1-year chart, making sure total volume is clicked, and we're going to draw the chart. Okay, now we have a weekly chart on the British pound. Okay, and you can see that April-May high unfold here. So we saw price drop down. Okay, so let's add a little bit of time to this because there is a little this is that area right here. Okay, now if one takes this high here down to this low, you can see that this is an optimal trade entry. Okay, this is an area where we would expect implied resistance, also noting that we did take out this old high as well. So price was really it was free to find lower prices because we were seeing higher prices poised in the dollar at the same time frame, April, May. Now also note that we were in a range between this low, okay, and this old high in here. Okay, now we did break out. Okay, we did break out there, but we saw a rapid increase in open interest. Okay, so what does that mean? If the open interest is increasing while within a larger trading range, okay, and one could argue really this is a large trading range here. We had a rapid increase of the open interest here. Gave up just a little bit before this run up, but ultimately we're added right back and above the previous open interest here with short. So they quickly added all those shorts back while we rallied up into a new high higher than this one, but we did not get back to this old high as well. So we traded right back into this range. Okay, so think about what we covered in the webinar, inside the range, and that concept is unfolding here. So now watch. We're going to be looking for this open interest or increasing shorts, okay, to be confirmed with what in the net trader's position. Well, if we pull that chart up, we should be seeing what? We should be seeing commercial traders going net short or adding to net short positions. Okay, and we're going to do this by adding a chart here. Okay, so now if we see the open interest increase like this, okay, we would expect to see what in the net trader's position chart? We want to see an increase of net short selling or a net short position or a rapid reduction in their net long position. That would confirm this, okay, as commercials themselves doing what? Expecting lower prices. So we go down here to this add study tab, click on that, go to commercial commitment of traders line chart, add that, then draw. Okay, and you can see here we have the chart noted. So we see here, and you can see the red line here. And we're gonna change it to a 1 year so we can see a little bit clearer. And if by clicking on the 1 year, we'll see that this red line here delineates the commercial activity. Okay, you can see how they rapidly dropped down from net long and net short while the open interest was increasing. So that was a confirmation that we were seeing net short commercial short selling. Okay, so if we see both open interest increasing like this and the red line here delineating the commercial traders, okay, they went from net long to net short going into May. Okay, so we saw this rally as a suspect false fake out type of move here, and we just ran out this old high and then obviously rejected it very harshly. Now this was the net short position, okay, held by the commercial traders expecting the top to form in the British pound. At a seasonal time frame when the dollar was poised to rally, okay, and seasonally when the British pound was expected to go lower, okay. So now we've confirmed two sides of the market, the dollar and the British pound. So let's see if we can see some support also in the euro. So we're going to go over to this tab here. We're going to go into the Euro FX tab, and we're going to use the first contract month. Go over to Customize, scroll down, and what we're going to do is just make sure we're on candlesticks. We're going to use the weekly nearest, 1 year, making sure total volume is clicked, and we're going to draw the chart, and we will arrive at the euro. Okay, and we have the March April time frame in here. Notice that the fiber was unwilling to make a higher high here. Okay, so we have that divergence, okay, between the pairs. So we have SMT divergence during a seasonal time when we would expect the fiber and cable to decline. We also expect to see the dollar to rally. Okay, so by seeing that, we also note that we have a trading range in here. Okay, the price is trading in a trading range. Okay, so same thing, just inverse relationship between the dollar and the euro. Because remember, we had the same thing happening in the dollar during the spring of this year in 2012. We saw the dollar ranging and then expected to see higher prices because open interest declined and commercial short selling was rapidly reduced, okay, in the dollar. So that's bullish. So we will see the same thing, hopefully, in a mirror image on the fiber. We're in a consolidation. Okay, April, May time period. So between this vertical line and this vertical line right in here, okay, we're in a range. Notice we saw open interest increasing. Okay, that's a nice increase of open interest during a time frame in the year when we would expect to see weaker prices. Also, we have an optimal trade entry from this high to this low, traded right up into that at the beginning of April. Okay, so we now have optimal trade entry during a time when we're seasonally weak, when we're expecting firmness in the dollar. Okay, and now let's go and add the commercials by COT and the commitment of traders line chart. Add that. Click draw. Okay, and you can see here we had the reduction. Okay, in other words, we had open interest increasing here, while we also saw the commercials in this case actually adding a little bit of their net longs in here. Okay, they were already net long above the zero line here, so they were all along here basically trying to catch this low here. So they were buying all this decline from this high down lower. So when price started to whip lower below this low here, at that very moment between April and May, there was really no increase of selling. In fact, they were actually buying more of it in here. Okay, so it's in this example, it acts much like the SMT, where we have the confirmation in the cable and the dollar, but on the COT, we don't really see it here. Okay, we've been maintaining a very large net long position on the commercials. Let's go and pull up 3 years of that and you'll see what I mean. You can see that we've had a net long position by the commercials for a very long time, and while we did drop down in here, there was no real indication that there was additional short selling here. Okay, they were lessening their longs here going into April, so that's the insight you glean, not necessarily this one here. So we did lose some net longs here, so we have confirmation in that regard, but between April and May, there was nothing to indicate the movement was confirmed between commercials and open interest at that particular moment. But if you look at this scale that we have here on the 3-year, you see how we had open interest increasing in here. We had open interest increasing in here while we saw a reduction of the longs. So that's more or less essentially the same thing. They're lessening their longs, okay, which is increasing their short positions, while open interest increased in here while we're in this range. Okay, so that was the catalyst for confirmation on the higher time frame. So while they didn't exactly line up between cable and fiber, both of them more or less had the indication going in. So fiber was giving it up here early, and as you can see, it's also supported with the fact that they were unable to make a higher high here in April when the cable was able to do that. All right, so that's one way of applying open interest, looking for the reduction and increasing of open interest for measuring smart money in the form of commercial traders and using the COT graph. And now we had this stage set for weaker prices in the spring of 2012. So now we have more or less the large macro view, okay, couple that with the interest rate market now. Okay, so now we have the COT, open interest, supporting the notion that the seasonal tendency for weaker cable and fiber and higher dollar in the spring, we see that also supporting the interest rate insights that we've already looked at. And now we have a sell program, okay, in place. Now we can look for shorts. We can start selling, okay, for a short position going into the summer months. Okay, we're looking at the dollar index. This is a daily chart, and we're zoomed into the April month of 2012, and we're looking at this, again, seasonal tendency for the market to decline on the British pound and usually be a risk off scenario. And obviously we'd be looking for a reverse scenario, which would be bullish for the US dollar. And we noted already this swing here. This is optimal trade entry in here where price would have been rallying from, or we would expect to see it rally from, and the sweet spot comes in at 178.85. So this would be a catalyst for upside momentum for the dollar, looking for this old high and this old high as upside objectives. At the same time that this is occurring, we expect to see weakness in the stock indices to anticipate a risk-off scenario. We saw the Dow this year in April make a very modestly higher high here, and this little rectangle is delineating the month of April as well. So we see a modestly higher high here, but let's look at the daily on the S&P at the same time frame. We have a lower high. Okay, see that? Now we already have an SMT divergence between the stock indices, and obviously the NASDAQ Composite Index also that same month was able to post a lower high. Okay, so we have SMT divergence indicating that we have underlying weakness. Okay, in other words, as this rally up into April, May time period, stock averages were not able to confirm one another. So Dow theory suggests that there's probably waning momentum, and don't be so aggressive in terms of buying because you may be seeing a withdrawal or a retracement lower. Let's go back to the dollar. Okay, and let's look at what happened from that point. Okay, you can see obviously the dollar itself rallied on up from this high and this low here, this range. Okay, if we look at just that, we can get some upside objectives for the dollar. Okay, and what we're doing is we're looking for, obviously, objectives, looking for potential areas where price may shoot to. Here's the 162 extension and a 200 extension here. Okay, now once price broke above this high, this swing, okay, is fine. You can still use those targets, but we got to go to the left side of the chart and look at the larger magnitude price swing that we're working within. So this high to this low. So we would use our fib tool from that high and pull it down to the lowest low in that fractal. Okay, so we have this high down to this low, and we will be looking for the 127 extension for upside objectives here, and 162 extension, which nails the high here. And moving forward, you can see the dollar had slipped off precipitously from that point. Now you can see hopefully here the value of using a higher macro view analysis approach to your trading. And if you see this type of event unfolding in the dollar, the same thing should be happening in the reverse, okay, on the downside on your other asset classes. And let's look at the daily on the Dow Jones. We saw price obviously slip lower as well, okay, confirming that upward momentum in the dollar. The S&P 500 also broke down and slipped lower. And the NASDAQ composite, not surprising, slipped lower as well. Now let's look at the fiber, okay, and what I have here is the April month delineated between the two red vertical lines, okay, and we're looking at the fact that we were unable to make a higher high here, okay. And just for a second, let's just shoot over to the cable, and you can see how in that same time frame in the month of April, the cable was willing and able to make a higher high. Okay, so let's go back to the fiber for a second. This market absolutely posted weaker technicals across the board. In other words, between the two pairs, fiber and cable, because they're so closely correlated, they usually trade in sympathy. But as you can see here, the SMT divergence, correlated pair SMT divergence, was showing that there was absolutely no interest whatsoever going long in the fiber. And if you recall back in when I was doing reviews, we were talking about this market being the weaker of the sisters all during this particular time frame. And this is really the catalyst for my viewpoints. And while I was saying it real time in advance before the markets were trading, we were looking for this old low to be traded to back in here. Okay, so, and also back here as well. Now this high and this high here, notice that we were lower here. Okay, so we have February's high and April's high lower in the fiber. Let's go over to the cable. Notice we were going higher in the cable. Here's February's high and April's high. So we were posting higher highs in the cable. This was the relatively stronger of the two pairs. So when there was a buying opportunity, we could be buying in here, okay, and be more confident that the market's going to be more favorable for us as a bull if we're a short-term trader. But we're focusing on the higher time frame, intermediate term basis. So we're looking for what? The sell scenario, and that being the case with the fiber. Okay, so you could look to sell this market here going into your seasonal time frame from this high down to the low. You can see we have optimal trade entry in here, and price did slide off. The cable at that same time frame, we had a larger price swing from this high down to this low that the cable was retracing in. Okay, so let's pull that up. You can see here's the sweet spot. Okay, here's that 70.5 fib level. Price went right to that level, exactly to that level. Okay, and I posted a market review and a daily review suggesting that I would be shorting at 163, a break above 163 figure. Okay, so if you go back to that time frame and look at the videos, you'll actually see me talk about being short here. And this is the reason why. We're within that April time period for seasonally expecting a decline. Okay, we went up into a higher time frame implied resistance level. We're at a figure, 163. Okay, so even though we were bullish compared to the fiber comparably, we are still within a time frame where the price itself should be running out of steam. And when we get to these levels like this, so far deep into a retracement of these price swings, you got to expect some weakness. So now let's look at what's happening here also. We have the high at April and the high at May, higher in the cable. Let's go back to the dollar. Look what's happening here. We have lower, albeit not by much, we have a lower low here than here. Okay, so the dollar was lower. The cable confirms it, higher. But let's go back to the fiber. See this? There's a USDX SMT divergence. Okay, so this tells you that you have a very, very large price swing possibly unfolding going forward. This tells you that it's going to be bearish for the fiber. Okay, and since tandem trading occurs in cable and fiber generally, and you're looking for higher prices in the dollar, you can get yourself in sync with a very, very handsome intermediate term short. And looking at this high here down to this low, in here is a sweet spot, and price went right up to that point by the pip and then fell out of bed. And let's look at what happened here. Price does in fact trade down below this low, in fact. Small little minor bounce in here and then finally broke through. Okay, and eventually even traded even lower than that. If you use the Fibonacci concept that we talked about for this plan, we look for 127 extensions, 162 extensions, and the 200 extension. This price swing is what we're going to use going lower. Okay, so if you use this low up to this high, once market structure breaks this low here, you're going to be looking for the 127 extension, which it finds here handsomely and bounces, and looking even gives you another optimal trade entry to get short. Okay, and this is, we're jumping ahead really, this is the short-term trading part of the series, but price does give it a correction here, trades right up into old support broken, now resistance, falls out of bed and goes what? 162 extension. And then obviously price had snapped away from that rather handsomely. So getting short here on the notion that we are entering into the seasonal time period and looking for SMT divergence is one avenue here that you could have got short. If you missed this one, this was the other opportunity to get short, okay, and ride it lower. That rather handsome price swing. If you look at what transpired just from the original high here in April down to the 162 extension, that's 1,230 pips. Okay, and if you got the second entry in here using the 1st of May area, it's a 1,150 pips. Okay, so not bad in terms of pip hauls. It takes a little bit of time to get these guys. It doesn't happen overnight, but you got to really hold on to it and just have a lot of patience with them unfolding. If you look at the cable, once price gets up into this inside the range concept, the sweet spot 163 is a big figure as well. We are still within the April seasonal decline time period. We have USDX SMT, we have correlated pair SMT, weaker highs comparable to the higher high in the cable here. So now what's going on in the lower time frame? Okay, let's just use a hourly chart. Okay, here's what's happening. Price trades up into that 163 figure, trades off. Okay, now as price trades lower like that, okay, it comes down into that 62% level here on a higher time frame price swing, finds a little bit short-term support level, eventually breaks down below it, and look, it comes right back up to that same level here again. See what it does here? Runs into it as resistance and then slides away. Again, aggressive move lower. Okay, now let's add to this the day separators. Okay, now if you missed just shorting straight up into the 163 figure, okay, you have a short-term high here. We have a higher high here, lower high here, and a lower high here. So this is a daily swing point. This high, this lower low, I'm sorry, lower high and lower high here. Okay, so we do have swing point here. So now we could be looking to get short beyond that point in here. Okay, you can use optimal trade entries. You can use reflections, anything that you use to trade on your pattern. That's what you start hunting. Okay, and we also have a higher price swing point on the weekly basis. Okay, see these double lines here and here and here. We have the high of that week, so between this double set and this double set, the high is here. Then we have the high here between these two, and then we have the high here between this set and this set. So what is that? That is a weekly swing high. So we have the high, and lower high. Pull that up on your own weekly chart and you'll see what I'm referring to. Now, when you have that also, okay, that's when you have the acceleration in the price movement much more aggressively moving lower. Okay, and when we see the high and lower high here on the new week, okay, going into Monday and Tuesday, using the how to capture explosive profits in the Forex concept we used in that video, you're looking for Monday to Tuesday's London Open to present you the high of the week. This is where this takes place. We have Sunday's trading, Monday runs up, okay, and it makes the high on Monday and then trades off. Now, if you miss that, that's fine. Don't chase price. You don't need to worry about rushing into it. Once you have now a daily and a weekly swing high, you can use the high down to this low here, and look what you have. You have the 79-cent retracement level laying directly on top of this higher time frame fib level that we just drew off the daily. Okay, that's the 62% retracement level on the daily, and now we have overlapping fibs on a 1 hour chart conversion right there for a optimal trade entry. This is a nice sucker rally. It gets everybody excited chasing it, but this time of day is New York Open, so you could be selling in New York Open to get in sync with the higher time frame and then ride it lower. Okay, and positioned there, you can see rather handsome declines, and these are the moves that you want to hold on to during an intermediate term price swing. 4 hour chart, and this is that opportunity for a seasonal decline in April here, and this is that lower high going into the beginning of April. If you use the high here and price trades down, if you look at the high here, pull it down to that low, you see how price goes right after the 79-cent retracement level and stays there for a little bit and then finally breaks down. Okay. Notice also that we have smaller optimal trade entries in that same area, and you have it here as well. Here, this high, low, and here, and it breaks down. See, this is why you have to understand how price can be fractal. Okay, it's not a hard concept to learn if you spend some time with it, but you have to definitely go through higher time frame charts and start breaking them down and looking at specific turning points. The absolute seasonal month that we're highlighting here is if you look at the high here to this low, okay, and the reason why I'm pulling this is because these are the highest high amongst all these candles, and this is the lowest low amongst all these candles. Okay, price goes right back up to the sweet spot, which is an overlapping of this higher time frame fib level and here. Okay, so you can see how that converges. So you can get short in here on even the 132.50 level would have been a nice opportunity to get short here and going much lower. So again, much in the same vein that we've shown with the cable, you can see how price did fall rather handsomely in the fiber. And again, here's that bounce at an old low, came up and gave you another optimal trade entry in here. And we'll just draw that in here real quick, just for the sake of completion. And set a nice retracement level in here. And you go down to a 5-minute chart, you can actually see optimal trade entry in here on this small little minor price swing. So again, another fractal pattern within a higher time frame fractal that's broken down to a smaller fractal, which is what we're showing here. So even looking at how price breaks down from these larger intermediate term price swings and then the 162 extension, look how it doesn't give you much in terms of movement below that before it snaps away. Okay, now if you held on to it and it breaks this high here, once price runs above that, you have now a break or a market structure shift. Okay, so you don't want to just collapse the trade there. You want to wait for it to try to retest and get back down to these lows. And by using another optimal trade entry, okay, you can see a better place to cover your short instead of just getting out here and panicking. You can get out down here at the 162 extension, and then obviously price starts to move away from that. Okay, so that's what looked at you in April, staring you right in the mug, okay, for long-term, intermediate-term price swings. And if you look at how the tools on a macro view really help you get in sync with these trends, you're just going to use the simple short-term analysis concepts to get you in the trades. Judas swings, intraday optimal trade entries, using the weekly concept of looking for the weekly high Monday to Tuesday's London Open, or at the very latest Wednesday's London Open. And if you're in bullish environments, you would use the weekly Monday, Tuesday London Open for the low of the week to form, or the latest Wednesday's London Open to capture the weekly low, and then get in sync with that and try to hold on to these things as long as you possibly can. It's very difficult if you're always just looking at every minor price swing in the market while you're in these. That's why it's much better if you're going to have this concept in trading and still do short-term trading. You need to have separate accounts, obviously, but you just put the trade on and let the stops stay outside of potential striking distance. And by that I mean, if you get short in here, you let it run down for a while before you do anything with trailing stop losses inside of it, because price can come back and tag you, and then you'll miss all this. Okay, so you want to look for support levels to be broken like it does here, and then comes back and retests it and trades lower. Then move your stop into a profitable area where you can lock in a very small portion of the profit, and then don't chase it. Don't trail it down too tight. Learn to scale out profits going down at the reasonable predetermined 127, 162, and 200 extensions. The fib levels for the cable, again from this high up here, this price swing here, okay, this price swing here is the second leg of this move here. So we have to use this price swing before we would ever use this one or this one. Okay, so with that concept, let's take a look at the lowest low candle here and to that high. Okay, and here is the 127 extension, and here's the 162 extension, and then here's the 200 extension here. Okay, you can see how price came down. Didn't get to this old low, but it did get to 200. So you could have scaled off, obviously, 50% of the position once you get half profit. I'm sorry, 30 pips, move to break even, and then look for your 127 extension. Now you could take 30% off of the total position, okay, or you could take 10, 20 at 62, and then leave the remaining portion to reach for 200, or you could just take the remaining 50%, divide it by 30 of the original position, take it off at 127, and then the remaining 20% would be off at 162 extension and not reach for the 200. Or you could just go for broke, and once it takes 127 out and starts reaching for 162, trail your stop down to the 127 for the remaining portion. So you can, if it comes back up, at least you're going to get out with your remaining half at a nice logical area to take profits. And if it gets down to 162, take half of it there off and have the remaining 25% reach for the 200, and then show your stop just above the 162 extension. Okay, but there's a lot of different ways, and I'm trying not to give you a very clear black and white way of doing it, because I want you to have some input on your own. There's a lot of freestyling you can do with these using the analysis concepts, and again, hopefully this has just been providing you an example on how to intermediate term swing trade, and using the higher time frame macro reviews to get in sync with the market and learn to anticipate price moves, and then using the smaller time frame concepts we've used in the other videos to help you with your timing and such, and those being the optimal trade entry video, the high probability price patterns video, and obviously you need to be cognizant of the risk and equity management. So those videos, they're very insightful and applicable, obviously, for this tutorial. So I'm going to close it here, and hopefully this has been insightful to you guys. And if you have any questions, obviously, just post them on the forums at babypips.com. And until then, I wish you good luck and good trading.